When you join an early-stage startup, your equity grant starts small, but if the company succeeds, the tax liability attached to those shares can grow into a financial avalanche. Filing one simple physical government form can save you tens to hundreds of thousands of dollars in future taxes. This graph shows a startup's stock valuation sharply rising over time. Under the default tax rule, you owe ordinary income tax on the value of your shares each time a portion vests. Because you haven't sold any stock, you have no actual cash to pay the bill. This creates a severe phantom income problem. You can bypass this default rule by filing a Section 83B election. This legal mechanism allows you to lock in your tax obligations on the grant date, when the share value is at its lowest. You pay a minimal tax bill upfront and avoid the recurring tax hits as your shares vest. We are going to walk through the foolproof, step-by-step process of filling out IRS Form 15620 and assembling the physical mailing packet required to secure this tax benefit. Mastering this specific administrative task provides the ultimate defense mechanism, protecting your startup wealth from devastating future tax burdens. You have exactly 30 days to file this election with the Internal Revenue Service, or IRS. If you miss this strict legal deadline by even one day, there are no extensions or exceptions, and the tax benefit is permanently lost. Beware of the grant date trap. The 30-day clock begins the exact day the company's board approves your grant, or the day you early exercise your options. It does not start on the day you finally receive the physical paperwork to sign. To start the filing process, immediately open your official equity grant document. If your company uses a digital cap table platform like Carta to manage its equity, log into your portal now. You must extract 4 specific data points from your document before you touch the IRS form: the grant date, the number of shares, the fair market value, or FMV, which is the current price per share, and the exact amount paid. Hunting down these official figures immediately prevents fatal calculation errors. Guessing your share price or grant date will invalidate your entire IRS election. Next, download IRS Form 15620. This is the official standardized document the government requires you to use to declare your election. Carefully input your personal details at the top. You are required to provide a Social Security number, or SSN. If you are a non-US founder, you must use your Individual Taxpayer Identification Number, or ITIN. Looking at the form mockup, go to Box 2 and describe your property, for example, 1,000 shares of common stock. Then, in Box 3, input the exact grant date you pulled from your official documents. Now move to Box 6. Multiply the fair market value per item by your total quantity of shares. This calculation gives you the total fair market value. Directly below in Box 7, multiply the exact price you paid per share by the total quantity. This gives you the total price paid. Box 8 calculates the exact gross income you are reporting to the IRS. Subtract the total price paid in Box 7 from the total fair market value in Box 6. If you received the shares at their current fair market value, your final result will be exactly $0. Be careful here. The IRS does not accept digital signatures for this document. You must print the form out and physically sign and date it in ink. A mathematically perfect, hand-signed Form 15620 legally transforms your unvested equity from an unpredictable tax liability into a protected asset. With the form signed, take it to a copier. Make at least 3 physical photocopies of the document. This schematic shows the exact requirements for your primary envelope. Address it to the regional IRS center where you file your income taxes. Place 3 documents inside: the original signed form, a brief cover letter, and one of your photocopies. Before sealing it, add a self-addressed stamped envelope, or SASE. This is a smaller envelope with your own address and postage already applied. You must include this so the IRS can eventually return a date-stamped copy for your records. Constructing this specific, multi-layered physical packet is the only leverage you have to force the IRS to provide tangible proof that you filed on time. Do not drop your packet into a street mailbox. You must walk the envelope into a post office and hand it to a clerk. Ask the postal clerk to send your packet using certified mail with a return receipt. You must use certified mail because the IRS doesn't issue digital receipts, send confirmation emails, or make phone calls to acknowledge receiving your election. The postal clerk will stamp a postmarked date onto your certified mail receipt. That date stamp is your ultimate, legally binding defense if the IRS ever audits your filing. The exact moment you hold that physical certified mail receipt in your hand, you shift the burden of proof entirely away from yourself and onto the government. Now, distribute your remaining physical copies. Give one to your employer's HR department so they can update their cap table compliance records, and file the last copy in your permanent personal records. Then, you wait. Weeks or even months later, the IRS will return your date-stamped copy inside the self-addressed stamped envelope you provided. Once it arrives, staple that returned IRS copy directly to your green USPS certified mail receipt and store it indefinitely. By executing these precise administrative steps before the 30-day deadline, you neutralize your tax risk and secure the maximum financial upside for your startup equity.